Something is still breaking. The crash didn't stop on Friday. It didn't pause over the weekend. It didn't give you time to breathe or think or process what just happened. It just kept falling. Right now, as I'm recording this, silver is trading near $74 per ounce. Let that number sit in your mind for a moment. 74. 3 days ago, on Thursday morning, that same ounce of silver was worth $122. Do the math with me. 122 to 74, that is a loss of $48. That is a collapse of 39%. In 3 days, not 3 months, not 3 weeks. 3 days. And the selling is not finished. This is not a dip. This is not a healthy correction. This is not profit taking. This is a liquidation event. This is what happens when the entire market realizes it was holding the same position at the same time, and the exit door is the size of a keyhole. We need to understand what is happening right now, because this is not just about silver. This is about leverage. This is about crowded trades. This is about what happens when momentum reverses and nobody wants to be the last one holding the bag. The dam didn't just crack on Friday. The dam is still breaking, and the water is still pouring out. Let me take you back to Thursday. Silver hit $122. It was a record. It was a moment that stackers had been waiting for. It was validation. It was euphoria. Gold was at 5,600. The precious metals complex was on fire. Everything was vertical. Platinum was exploding. Copper hit all-time highs. The entire commodity space looked unstoppable. And then Friday morning happened. The news broke that Donald Trump was nominating Kevin Warsh to be the next chairman of the Federal Reserve. And everything reversed in seconds. Silver collapsed 31% in a single session. It closed at $78. Gold fell 11%. It was the worst day for silver since March 1980. It was the worst day for gold in over a decade. The explanation from the media was simple. Warsh is a hawk. He believes in high interest rates to fight inflation. The market had been pricing in a dovish Fed chair, someone who would keep rates low, someone who would keep printing money, someone who would keep the debasement trade alive. Instead, Trump picked the opposite. He picked the guy who wants to kill inflation, even if it crashes the economy, and the market panicked. But here's what most people don't understand. The Warsh announcement was just the match. The real problem was the gasoline. The market was already soaked in leverage. It was already crowded beyond belief. Everyone was long. Everyone was bullish. Everyone had bought the same trade at the same time. When you have that much concentration, that much borrowed money, that much optimism in one direction, all you need is a tiny spark to create an explosion. And Warsh was that spark. Let me explain what a crowded trade looks like. Imagine a stadium with 50,000 people inside. Everyone is having a great time. The game is exciting. The crowd is cheering. And then someone yells fire. What happens? Everyone runs for the same exit at the same time. The doors are not big enough. People get trampled. Panic spreads. That is what happened to silver on Friday. The crowd was long. The crowd was leveraged. And when Warsh was announced, the crowd stampeded for the exit, but the exit was too small, so the price collapsed. Traders were forced to sell. Margin calls were triggered. Algorithms started dumping, and the cascade fed on itself. The more it fell, the more people had to sell. The more people sold, the more it fell. This is called a liquidation cascade, and it is brutal. But Friday was just the beginning. Over the weekend, the smart money looked at the charts. They looked at the leverage data. They looked at the open interest, and they realized something terrifying. The unwind was not finished. There were still too many long positions. There was still too much froth. The correction had further to go. So when the market opened on Monday morning in Asia, the selling resumed immediately. Silver dropped another 12%. It fell from 78 to 74. Gold dropped another 6%. It fell below 4,500. The precious metals complex continued to bleed. And this is where we are right now, Monday afternoon. Silver at 74. Gold struggling to hold 4,500. The crash is ongoing. The liquidation is still in progress. Analysts are using words like air pocket and crowded long and unwind. José Torres at Interactive Brokers said the Buy America trade is back, and the independence bid that drove metals to nosebleed heights is unraveling. Christopher Forbes at CMC Markets called it a classic air pocket after an extraordinary run. Michael Brown at Pepperstone said the market was highly bubbly. Positioning was extremely crowded on the long side. Everyone rushed for the exit simultaneously, forcing prices lower, which triggered further forced selling. Momentum works in both directions. Let me repeat that last line because it is the key to understanding what is happening. Momentum works in both directions. For months, silver went up because everyone was buying. The momentum was bullish. Every dip was bought. Every breakout attracted more buyers. The feedback loop was positive. But now the loop has reversed. Now every rally is sold. Every bounce is used as an exit opportunity. The momentum is bearish. And just like the rally fed on itself, the crash is feeding on itself. And here is the disturbing part. We are not at the bottom yet. How do I know? Because the leverage has not been fully flushed out. because the margin calls are still happening, because the dollar is still strengthening. The dollar index has risen 0.8% since Thursday. That might not sound like much, but in the world of commodities, that is a significant move. When the dollar strengthens, it makes gold and silver more expensive for foreign buyers. It reduces demand. It puts downward pressure on prices. And right now, the dollar is rising because the market believes Warsh will keep rates high. High rates support the dollar. High rates crush commodities. High rates are the enemy of the precious metals trade. So as long as the dollar keeps climbing, the pressure on silver continues. But there is another force at work: Chinese speculators. For months, retail investors in Shanghai were piling into silver futures. They were adding leverage on top of leverage, but Chinese retail traders panic fast. When the trend reverses, they dump everything and run. The Chinese speculators who added froth to the rally are now exacerbating the crash. The selling pressure from Asia has been relentless. Every time the US market tries to stabilize, Asia opens and the selling resumes. This is a global liquidation happening across time zones. Now let me address the question that everyone is asking. Is silver going to zero? Is this the end of the bull market? Is everything we believed about the debasement trade and the supply deficit and the industrial demand, was all of that wrong? The answer is no. The fundamentals have not changed. Silver is still in a structural supply deficit. The mines are not producing enough to meet industrial demand. Solar panels still need silver. Electric vehicles still need silver. The global energy transition still requires massive amounts of silver. Central banks are still buying gold at record levels. Government debt is still exploding. The debasement trade thesis is still valid. What changed is not the fundamentals. What changed is the sentiment. What changed is the leverage. What changed is the positioning. The market got ahead of itself. The rally was too fast. The leverage was too high. The crowd was too concentrated on one side. And when that happens, corrections are violent. They overshoot. They punish the late buyers. They shake out the weak hands. This is classic mean reversion. Silver went parabolic. It disconnected from reality. Now it is snapping back. But mean reversion does not mean the trend is over. In the 1970s, gold rallied from $40 to $200, then crashed 50%. Weak hands sold. The crowd declared the bull market dead. But gold hit $800 later in the decade. The shakeout flushed out speculators. Then the real move happened. We might be witnessing the same pattern. Silver ran from 30 to 122 in under a year, 400%. Unsustainable. It needed to correct. Some analysts argue this crash is healthy. It resets valuations. It clears excess leverage. It creates a base for the next leg. But you have to survive the crash first. That is where most retail traders fail. They buy at the top. They panic at the bottom. They sell right before the reversal. Right now, if you were holding silver, you're down 39% in 3 days. Your account is bleeding. Your emotions scream at you to sell. Cut the loss. Get out before it goes lower. That is exactly when smart money steps in. When institutions start accumulating, when long-term holders add to positions. They know this is not the first time. They know volatile corrections are part of every bull market. They know best buying opportunities happen when everyone else is selling. Let me give you a historical example. In March 2020, when COVID hit, silver crashed from $18 to $12 in 2 weeks, 33% collapse. The crowd panicked. Forums filled with despair. What happened next? Silver rallied to $30 within 6 months. People who sold at 12 missed the entire move. People who bought at 12 doubled their money. Do not sell into a panic. Do not let liquidation scare you out of a long-term position. Now, I know what you're thinking. How do I know this is just a correction and not the end? How do I know silver is not going back to 30 or 20? The truth is, you do not know. Nobody knows. But you can look at probabilities. You can look at fundamentals. Right now, probabilities favor a bottom forming soon. The selling is climactic. Fear is extreme. Leverage is being flushed. Weak hands are capitulating. These are signs of a washout. These conditions precede reversals. But the reversal might not happen today. It might test lower levels. It might scare you one more time before it turns. Bottoms are messy. They are emotional. They break your spirit right before the rally begins. So what should you do? If you are holding physical silver, do nothing. Physical silver has no margin call. Physical silver cannot be liquidated by a broker. Physical silver is yours. It sits in your safe. And it will be there when the storm passes. If you are holding paper silver, if you are trading futures or ETFs or options, that is a different story. You need to manage your risk. You need to check your leverage. You need to make sure you can survive another 10 or 20% drop without getting wiped out, because this market is not done choking out the overleveraged. If you are thinking about buying, if you have cash on the sidelines, this might be an opportunity. But do not try to catch the falling knife. Wait for signs of stabilization. Wait for the bleeding to slow. Wait for a base to form, and then scale in slowly. Do not go all in at once. average and over time, let me tell you what the smart money is doing right now. They are watching, they are waiting, they are calculating. They are not panicking, they are not selling, they are preparing to buy, because they know that in 6 months or a year, this crash will be a distant memory. It will be a footnote in the history of the bull market. It will be the moment when silver was on sale and most people were too scared to buy. But there is one more danger that could extend this crash. JPMorgan. Marko Kolanovic, former chief strategist at JPMorgan, made a shocking prediction. He said silver will trade at roughly half its current price later this year. If silver was at 100 when he spoke, his target is $50. 50. Another 32% drop from 74. Why? Because silver is not like gold. Silver is volatile. Silver responds dramatically to fear and greed. Silver punishes late buyers. Kolanovic believes the speculative froth was extreme. The rally was driven by momentum and leverage, not fundamentals. When momentum reverses, silver crashes harder than any other asset. He pointed to the 1970s. Silver rallied alongside gold, but was more volatile. It went higher on the way up and crashed harder on the way down. Same pattern now. Silver bulls are pushing back. They argue this time is different. The structural deficit is real. Solar and industrial demand create a supply shortage that did not exist in the 70s. HSBC expects the deficit to widen to 1.2 million ounces this year. Fundamental support exists beneath the speculative froth. But fundamentals do not matter in a liquidation. Fundamentals do not stop margin calls. Fundamentals do not prevent forced selling. In the short term, sentiment is everything. Right now, sentiment is bearish. Price action is ugly. Momentum is down. Even if Kolanovic is wrong about $50, even if bulls are right long term, the next few weeks could be painful. Silver could test lower levels. It could flush out more weak hands. This is the trap. You think the bottom is in. You buy the dip, then it dips again and again until you capitulate, until you sell at the actual bottom. That is when the reversal happens. So here's my message. If you believe in the long-term thesis, if you believe in the supply deficit and the debasement trade, then this crash is noise. It is a test. The market is asking you a question. Do you really believe? Or were you just chasing momentum? If you were chasing momentum, you will sell here. You will lock in losses. You will swear off silver forever. But if you really believe, if you understand fundamentals, if you have a long-term horizon, then this crash is an opportunity. History shows best returns come from buying during panic. History shows the crowd is always wrong at the extremes. Fear is the friend of the patient investor. Do not let the 39% drop break you. Do not let the liquidation scare you. Do not let talking heads convince you the bull market is over. The bull market is not over. The correction is happening. Corrections are healthy. They reset the market. They clear excess. They create foundation for the next move higher. But you have to survive the storm. You have to hold through the fear. You have to resist the urge to sell at the bottom. In 6 months, when silver is back above 100, you will look back at 74 and realize it was a gift. You will wish you had bought more, but only if you have the courage to act when everyone else is frozen in fear. This is not the end. This is the shakeout. This is the test. The market is watching to see who passes and who fails.